A very happy new year to all our viewers and indeed to all Nigerians. The Finance Act 2020 is here. Yes, and so is the Federal Government Appropriation Act 2021, otherwise known as the budget. Don't be confused. Tax laws are put in place to guide budget implementation, and so they must be in existence to drive budget implementation. The Finance Act 2020 has amended a total of 14 Nigerian tax laws. So, Budget 2021 is on firm grounds. Now to our guest corner. Our guest on today's episode is here to fill us in as to what we need to know with regard to Finance Act 2020. Mr. Albert FOLORUNSHO is the Managing Consultant of Pedable Professional Services. He has had the singular honor of being involved in putting together the last two Finance Acts. Mr. FOLORUNSHO, welcome to Tax Matters.
Thank you very much for having me.
So I want to look at the Finance Act 2020, which is now a law, and it is the second in a row. Could you please give us the highlights of this Finance Act 2020?
All right, thank you very much. Of course, following the trust of the national budget, the Finance Act is meant to stimulate and provide avenue for government to be able to achieve what has been budgeted. And of course, everything has to do with finance. And so if you look at what happened in 2019, the Finance Act was signed into law, and it is expected that there will be a follow-up. Okay, several issues were already in the tax law before the 2019, so there will be follow-up to correct some of the new provisions and to also address some other areas. So specifically, the Finance Act 2020 covered various taxes, including the company income tax, the capital gains tax, the personal income tax, the Industrial Development Income Tax Relief Act. It also covered the stamp duties, the value-added tax, some small amendment on education tax, went down to the Unclaimed dividend fund was included in the Act. Of course, the Crisis Intervention Fund was also covered, and of course, some other fiscal responsibility aspects of the fiscal policy of the government were all covered.
Which of those changes in this Finance Act 2020 are you particularly excited about?
Excited? Well, you know, and you come to the VAT Act, there's a provision specifically that has to do with VAT on property, VAT on land, and VAT on interest in land. Okay, interest in land has to do with rental. Okay, so with the definition of goods and with the definition of services, now clarifying that there is no longer VAT on those transactions. That is very exciting. Again, if you are into agricultural business, okay, there are several provisions that have been made in the law such that when you hire equipment or implement or machinery or tractor for the purpose of agricultural business, the farmers now are not required to pay VAT. Okay, that is a major thing for the farmers. And again, farmers, if you look at the provision in CETA, IDITRA has also made provision that if you are into small and medium scale farming, you can obtain tax relief. You can obtain a tax holiday, an initial holiday of 4 years, which can be extended for additional 2 years. That is now in IDITRA, specifically for medium and small scale farming business. Again, if you go to this may not be for companies that are operating in the oil and gas export-free zone and the Nigerian export zone. The government has now required that they should file returns like any other company under Section 55 of CETA. That will give information to the Federal Revenue Service to see whether they are operating into the custom territory and whether there are income that should be subjected to tax or not. All of these are exciting provisions that I believe will help our tax system, and of course will help agriculture, will help the airlines, because when you fly now, local flights, the VAT has been removed by this provision, so there's no more VAT on tickets, okay, locally. And I think even internationally is not there. So that is very exciting. And we expect that, when the tax law is certain, it is well made known, the compliance, I believe, will improve. And the taxpayer will be better for it, even though government is also focusing on how to generate more revenue.
Let's look at some of the provisions in this Finance Act 2020. Right. Let's take the provision that has to do with unclaimed dividends. The provision said that these funds will be transferred to the Unclaimed Funds Trust Fund, which will be managed or supervised by the Debt Management Office. Now, this has really raised some concerns in the public space. I want to get your perspectives. Do you see these funds to be replaced, or is the government borrowing this money, and also will it yield interest?
All right. Specifically, it has to do with the Unclaimed Fund Trust Fund. And the two aspects that are covered is specifically unclaimed dividend and dormant account balances. Now, the unclaimed dividend is applicable where the dividend is unclaimed for at least 6 years, and it relates to a public limited company, for PLC. For private companies, it will become unclaimed if it is left for at least 12 years. That is as provided under KAMA, and it's not covered under this provision. And for the private company, where it is unclaimed for that 12 years, okay, it goes back to the shareholders or go back to the company. But this specific one has to do with unclaimed dividend, and then, of course, dormant account, if the account remains dormant for at least 6 years. Now, the fund is to be transferred to the Debt Management Office to be managed on behalf of the shareholders and the account holder. The present status now is that the funds are with the companies or the registrar or the deposit money banks in case of dormant account balance. And when you need your fund, you go back, claim from the entities. Okay, so the provision now is that government wants those funds to be managed on behalf of the owners. Okay, and when the fund is transferred to the Debt Management Office, there's a governing council that has been provided for in the Act to be headed by the Minister of Finance and somebody from the private sector of irreproachable character. And of course, we have the CBN governor as a member of the governing council, somebody from NDIC, representative of the registrars of company, and 2 members of the shareholders association, as well as the DG of Securities and Exchange Commission. Of course, the DG of Debt Management Office, who will be managing the fund, will also be member of the committee. Now, the question is, where is this coming from? If you look at other claims, it is not only unclaimed dividend that is covered by such trust fund, so that you can manage it on behalf of the owners. We also have unclaimed pension. We have unclaimed life assurance policy. We have unclaimed security assets left in the bank. Okay, all of these, where do they normally arise? Because people die, and maybe information are not provided, they are unable to claim the fund, people change their address, they cannot be traced. So all these funds are hanging all over the place in banks and in the hands of registrars and companies. Of course, the shareholders association have said that we prefer to continue to manage this fund, instead of giving it to government. But of course, again, the second need is the fact that apart from the fact that government will also facilitate for this fund to be made available to the owners, government needs the fund. And so whatever is transferred to the trust fund is more like a borrowing by the government. Okay, and of course, a borrowing means that we expect that there will be yield on this fund when it is eventually required. For now, if you have unclaimed dividend and you go and claim it, you just get your face value. But with this trust fund, you get it in addition to a yield. And there's some element of certainty that government is not likely to die. And so your money is secured. Okay, it is just the procedure which we expect the minister and the governing council to set out the policy around how it will be operated. What is the rate of interest that those funds will yield? How will they be able to track the owners? Okay, what type of returns are expected to be forwarded when those unclaimed dividend schedules are being forwarded, so that they can be tracked? How will government help those who have been trying to claim, particularly when it relates to probate. You know, when people die, you know, a lot of bottlenecks trying to get, those are where the fund is coming from. Government should also help to ensure that all these probates can be facilitated and people can have access to their fund as quickly as possible. So that is just the whole thing. Apart from the fact that they want the money to be secured, I can assure you, government also needs the fund. So they are borrowing the fund.
Fair enough. Now, let's look at the provision that has to do with minimum tax for companies, which has now been reduced from 0.5% to 0.25% for the period of just 1 year. Now, some of the view that this should be totally removed. Do you agree with that?
Well, if you look at the 2019 Finance Act, it came up with this revised minimum tax provision that is now strictly based on the turnover at the rate of 0.5%. A lot of industry complain about the unfairness. I mean, there are several industries that the margin on their turnover is so thin that you cannot be assessing them to tax on the basis of the turnover. But of course, government want to generate revenue. And so petitions were written, appeal were made, and government is considering reducing it, particularly in this era of COVID where companies are struggling. They have agreed to reduce it to 0.25% of turnover for a sunset period of 2 years. It's not really 1 year. But I have noticed that error in the Act, which tends to say that it is only for 2 years of assessment, including 2020 and 2021. It is actually accounts that ended in 2020 and 2021, so that they'll be able to enjoy that minimum tax at 0.25% for 2021 year of assessment and 2022 year of assessment.
So
it's actually for 2 years. But if you look at the way it is in the Act, it suggests that it applies to 2020 year of assessment and 2021 year of assessment. But of course, you know, we have already filed for 2020 year of assessment based on 2019 account, and most companies have paid at the rate of 0.5%. Okay, so the intention of government is not for this thing to apply retrospectively. I mean, it looks as if it will be requiring them to come and claim refund. That is not the intention. But I'm sure they will also be looking at this before the end of the year when they're preparing for the 2021 Finance Act. So for me, it's a good thing. Like you said, nobody wants to pay tax when you have not made profit. It is just the genuineness of returns that is making government to apply that provision. We hope that down the line when our tax to GDP rate is improved and there is improved compliance with tax, the issue of minimum tax should be removed.
Now let's look at the provision that exempts minimum wage earners.
Okay. Well, that is government trying to help the low wage earners. Let me state that it applies to only employees. So it's not, has nothing to do with traders. Traders are already exempt if the turnover is 25 million and below, you know, at 0%. Okay, so this is strictly for employees. If you are a minimum wage earner, which means you earn 360,000 per annum, you are exempted from paying tax. But that does not stop the company, who is your employer, to file returns and include your name so that you can even get your tax clearance certificate, whether you're a minimum wage earner or not. So you are still required to file returns as the employer.
That's very important, filing of returns. One interesting provision in the Finance Act is the one that has to do with the provision for donors of the COVID-19 fund, which is either in cash or in kind. And this allows tax to be deducted on 10% assessable profit. Is this applicable to both corporate entities and individuals? Because we know that some individuals also give out funds.
Yeah, the provision is actually section 25, subsection 8 of CETA. And so CETA covers only companies. So that provision does not apply to individuals. It applies to companies that have made donation towards the COVID, either in cash or in kind. A lot of people finance the isolation centers. A lot of people still have some of those isolation centers running. They bought equipment, they bought PPE, and all sorts of things. And so the sense of this is just to compensate those who have been magnanimous in supporting government in this trying time. And the provision is to the extent that the maximum claimable is 10% of assessable profit. The provision in Section 25 actually for other subsection is 10% of total profit, which means your assessable profit then less your capital allowance. But this one is applicable before deducting capital allowance, after you have made all other deductions and donation. So it's not insignificant, but at least it's a show of appreciation from government, to say the least. It's nothing that significant.
Let's look at the provision under Stamp Duty Act, whereby the electronic money transfer levy now replaces the stamp duty on electronic money transfers. The provision states that the revenue accruing from the stamp duty collection shall be distributed on the basis of derivation to the federal government and the 36 states. Now, how would this derivation be done? Because we know that some states will generate more revenue from this than other states.
Thank you very much. It is important to clarify the difference between collection and utilization or sharing of the fund. Now, the provision of Section 4 of the Stamp Duties Act of 1939 is that, the person responsible for collecting stamp duty depends on the parties to the transaction. If the parties to the transactions are just two individuals, it is the responsibility of the state to collect the stamp duty. But where an individual and a corporate body is involved, or two corporate bodies, it is the responsibility of the Federal Inland Revenue Service to collect. So there are no controversy around that, okay? Because that has been the argument that has been on for some time. Now, when it comes to utilization, stamp duty is covered under Section 163 of the Nigerian Constitution. And subsection A and B, emphasize the fact that stamp duty strictly belongs to the state after the cost of collection has been deducted by the collector. Okay, so any portion of stamp duty, anyone collected by the state, automatically the state utilizes it. But the one that is being collected by the federal government, okay, that has to do with corporate body, particularly this electronic money transfer levy, which it was under stamp duty, but more or less looking like a standalone, but still part of stamp duty, and it is now electronic transfer levy. Okay, the 15 naira that is debited when you make a transfer. Okay, so that has to be determined who is the real beneficiary. Of course, it is still the FRS that is collecting. The question is who is supposed to utilize it, and that is where the sharing formula, is very relevant. It says that 15% of such fund goes to the federal government and the FCT. For me, that is more or less like the collection cost, okay? And then the 85% is to be shared among the states based on derivation. The basis for sharing, that derivation has not been defined. But of course, you are looking at who bears the cost, who is paying the stamp duty. If it's an individual paying the stamp duty, automatically we assume that it is where the individual is resident, it is the state where the individual is resident that should benefit from that particular stamp duty, okay? And if it is between two companies, maybe you start looking at, okay, where is the transaction emanating from? Is it from the head office? Is it from the branch? We believe that NEC will have a lot to do to clarify that, or maybe they will probably come up with a different sharing formula entirely, because this is a bit cumbersome and because some political economic issue between federal government and the state, and even among the states, because people they are already looking at where is the transaction taking place. Yeah. Is it Kano, Kaduna, or Lagos? Some people are jubilating while some are saying, let's look at this sharing again. That is purely NEC to resolve.
Do you provide goods and services? Then you must answer these important questions. Are you registered for VAT? Do you charge VAT on the goods and services you provide? Do you keep records of all your transactions? Do you file VAT returns? Do you remit VAT collected to government coffers? If your answer to any of these questions is no, then you are breaking the law. The law demands total compliance. Therefore, you must register for VAT. You must charge VAT on goods and services. You must file VAT returns. And you must remit all VAT collected on behalf of government within 21 days to the bank nearest to you. To do otherwise is a crime punishable everywhere in the world. VAT is prescribed by the law. Do the right thing. Collect and pay VAT. This message is from the FIRS. It pays to pay your tax.
Welcome back. We are still looking at the Finance Act 2020. Our guide is still Mr. Albert FOLORUNSHO, Managing Consultant of Pedable Professional Services. We need some clarification with regards to the provision that has to do with the exemption of 2% education tax for companies. Now, I want to know if this provision is for all companies or for some categories of companies.
Well, it's for small companies, not for all companies. Small companies is defined under SITA, and of course has been defined here as companies with turnover of not more than 25 million. Okay, those are the people applicable. If your turnover is above that, you are medium scale between 25 and 100, and then above 100, you are a large scale. The education tax is still applicable for such large scale companies. It's strictly for small companies. Just to align it with the provision of SITA that says small companies are now exempt from 30% tax. So if you're already exempt, why pay education tax at the same time?
Now, could you please elaborate on this severance pay on the Finance Act under capital gains tax? Okay,
yeah, that has to do with the Capital Gains Tax Act, compensation for loss of office. You know, in the Finance Act of 2019, it says that where the compensation is not more than 10 million, it is exempt from CGT. So there was a misconception or misunderstanding of the provision. So what has been done in the 2020 Finance Act is to just correct that misconception so that it can be very clear. So it says that it is only the amount above 10 million that is liable to CGT at the rate of 10%. Okay, so which means if you are paid 11 million as compensation, okay, for loss of office, that is, loss of office means you are in a contract employment and that employment is prematurely terminated. You are terminated without notice, and so you are paid compensation. So the rule is that the first 10 million of any compensation will be exempt. Anything above that will be liable to CGT at 10%. And the law has now been amended such that it is now the responsibility of the company making that payment to deduct the 10% CGT and remit to the relevant tax authority.
Okay.
Yeah.
Finally, sir, there is this provision that has to do with the telecommunication service providers in Nigeria, whereby they will not be charged duties of excise at the rates as specified in the schedule of the order provided. Now, how do you think the telecommunication industry will take this? Well,
it's an additional cost to the public, really. But it has not been defined. It is under the custom and excise duty. So they are not taking a telecommunication service as liable to excise duty. So which means a certain percentage will be added for every call, more or less. Instead of paying 50 kobo, maybe a small percentage will be added to it. Okay, that is excise. Excise is not only for locally manufactured, it can also apply on service. And so federal government is trying to start that local excise on telecommunication service because they believe that Nigerians waste a lot of credit on talking, and so they would rather just see whether they can take a cut out of that. But that has not been triggered. The president has to make a provision for that, and then we'll now get to know how that will operate.
Of course, it will mean more revenue for the government. Actually.
Well, that's, I mean, the government has taken so much debt. They are looking for ways of servicing those debts. Okay, if you look at the budget, we have a 13.6 trillion budget, out of which we expect to raise internally generated revenue of about 7.9 trillion. The balance is to be financed from debt. That debt has to be serviced. So government is looking for all sources.
There you are, the Finance Act 2020. One good thing is that the government has promised a yearly review of the Finance Act. So whatever is not included in this Finance Act 2020 will be included in Finance Act 2021. We want to thank you most sincerely for watching, and please stay safe till we come your way again next week. Bye for now.